All right, let's start with chapter 3, risk assessment and internal controls. This standard comprises of essay 315, 320, 330. Other than that, there is a concept of internal controls, which is actually aligned with 315 only. Then there are some other concepts like digital audit, data analytics, and all. Now, let's go to first question. First question. XYZ Limited is engaged in the business and running several stores, dealing in variety of items such as ready-made garments for all season shows, gift item, watches, etc. There are security tanks on each and every items. Moreover, the inventory records are physically verified on monthly basis. Security tags hoga ye, sorry. And moreover, the inventory records are physically verified on monthly basis. Discuss this type of inherent control, inherent risk, control risk, and detection risk as perceived by the auditor. They have given you a scenario in which there is a business. There are several stores, and the items such as ready-made garments, all season gift item, watches are there. Each of these items has tags attached to it. There is a proper inventory record is maintained. Along with that, physically that inventory records are also verified. Now in this case scenario, we have to identify the risk. What is the inherent risk, control risk, detection risk that auditor perceives? But before we go into that concept, we have to understand what is audit risk, right? Audit risk is a risk that I, as an auditor, might end up giving inappropriate opinion when the financial statements are already misstated. Are you understanding how foolish this would look, that the financial statement has a problem? Either the depreciation is not calculated well, or the provision for bad debt is incorrect, or the investment valuation is incorrect. Something is wrong in the financial statement, but I still tell in my audit report that the financial statement is giving true and fair view. It is free from any material misstatement. And that is exactly what is audit risk. When the financial statements are misstated, but you still give a unmodified opinion. Are we clear with the definition? Learn this, huh? It will be asked in your exam. Now,
Okay.
when you say audit risk, okay, so you might give up, and you might end up giving an unmodified opinion when financial statement is misstated. Can there be a situation? Can there be a situation? I'm just creating a situation when the financial statements are clean, means do not contain any misstatement. Still, you'd say, no, it is containing misstatement. I will modify the opinion. I will give either adverse opinion or I will give qualified opinion. Can there be this risk that the financial statement is clean and still you modify the opinion into adverse opinion or qualified opinion?
Yes, ma'am.
The answer is no. That is not the audit
Okay.
risk. Then you are not a credible auditor only. If your financial statement contains no misstatement, you are still saying that it is containing the misstatement. So this situation
The
is not
exact
the audit.
opposite.
Exactly. The
Okay.
risk that the financial statement are misstated, but still you say that financial statement are clean. That is the audit risk. But we are not foolish auditors now. The financial statement does not contain any misstatement, we will still give the adverse opinion. That is not going to happen, right? So just remember, that is why vice versa you can't do over there. Just wanted to highlight this. Remember this, Now. So that is why they are saying over here, what is not included in the audit risk? See the second point. Risk
Business
that
risk
auditor,
and
Yeah, so auditor might express an opinion that financial statements are misstated, which are when they are not. That is not going to happen. And second, any business risk is not covered as part of your audit risk. Now, please understand there is a audit risk is not like one single risk. Audit risk is a function of risk of material misstatement and detection risk. And you know that, right? Audit risk is a function of risk of material misstatement and detection risk. Under risk of material misstatement, there are two components, one inherent risk and one control risk. We will read the example so that we get some clarity on what is inherent risk and what is control risk. What is inherent risk? That accounting standard providing guidance on complex issue which might not be understood by the management, and that is why management has prepared financial statement according to however they have understood that accounting standard, and that is why the financial statement is incorrect or financial statement contains a misstatement. Now you can't change anything into that. Now this is inherent. That problem is already there. It is the management understanding problem, and management was preparing applying that accounting standard throughout the year. So how are you going to control that? Are you going to sit in their office and make sure that they understand all the accounting standard every time they are passing accounting entry into the accounting system? Can you do that? Is there our responsibility as an auditor? No. So there can be a scenario that the financial statement can be misstated because of the inherent limitations, inherent risks involved. Second, due to business failures in an industry, assertion in the financial statement are being misstated. For example, I am part of the IT sector. Like, my business is in the IT sector, and suddenly there is a big recession going on due to which I am not getting the good business. Not just me, other my competitors are also not getting. It is an entire economy downfall. Now, I want to raise some loans from the bank. Now, due to business failures and the overall industry failure, my financial statement will not look good. How the bank will give me loan? So I started manipulating the numbers. Now, this is something you can't assume as an auditor that client will do that, but client is doing that. They are misstating their financial statement so that they can raise funds from the venture capitalist, from the bank, and from any other party. This is also inherent. So, how do you define inherent risk? It is susceptibility of an assertion about a class of transaction or account balance or disclosure to a misstatement that could be material, assuming that there were no related internal control. There is an assumption only that there is no related internal control, Baba. Client can do this, client can make this mistake or they can manipulate the financial. And they can manipulate any transaction, any account balance, or any disclosure in the financial statement. ठीक है. So inherent risk is not like prevailing in every single entry, like they are making they are making misstatement in the sales entries only. That is not going to happen. There will be very specific class of transaction, some account balances where the client is going to make that mistake. Just wherever, for example, it may be higher for the complex calculations. Are we clear, guys? Inherent risk. Can you please memorize this? I really want you to, understand and memorize the inherent risk definition because it may be asked in the exam, right? Chapter 3 is very important for your entire syllabus. Done?
Yes, no.
Next is control risk. Control risk very simple. Control risk is client has actually implemented some controls in their office, but still because of certain things that controls did not work effectively and it could not prevent that misstatement from happening. So risk of misstatement that could occur in an assertion about a class of transaction balance or disclosure that could be material will not be prevented. It will not be prevented, detected, or corrected on timely basis by entity's internal control. Under inherent risk, the assumption was there are no related controls. What is a related control to the business risk? Nothing. But in case of control risk, there is a related internal control, but it is not able to prevent the misstatement. Right? For example, the controls are devised that cash and checkbook are kept in lock safe and access is granted only to authorized person. But the risk is authorized person only can, there can be theft, he can be involved. Or the controls are advised that the petty cash transactions of only less than 10,000 should be routed through the Impress system. But there is a risk that the control is not being followed. You can apply n number of controls, but if the people are colluding among themselves to do the fraud, they can still do the fraud and your controls will not be able to prevent anything. Right? So that is your risk of material misstatement, inherent risk, and control risk. Now, but that is not all. You cannot just blame anything to everything to client. There can be some risk that can come because of you as an auditor. Listen, you may also fail to detect material misstatement because of two reasons. Either it can be sampling risk or it can be non-sampling risk. What is sampling risk? That the samples you have selected did not contain any misstatement, but whatever items did not come into your sample. For example, out of 100 transaction, you selected 50 to check. In this 50 transaction, there were no misstatement. But in the remaining 50, at least 50% of transactions of the remaining 50 were misstated. It just didn't get captured into your sample, right? That is the sampling risk. Non-sampling risk is that financial statement was misstated. You could not capture it because you applied wrong audit procedure. Right? So you have the discussion of sampling risk and non-sampling risk in your essay 530 as well, I guess. Non-sampling risk is auditor reaches to the erroneous conclusion for any reason not related to the sampling risk. Right? Now, let's come to the question what we were doing. That XYZ Limited is engaged in the business and running several stores dealing in the variety of items such as this and that. We have to identify out of all this what can be the inherent risk over here, what can be the control risk, and what can be the detection risk. Inherent risk is there that even though all the items have tags attached to it, sorry, even though there are tags or there are no tags, doesn't matter, there is no, you don't have to assume any controls. The problem over here is in the inherent risk that I can still collude. I can still, if I as an employee or as a senior professional, senior key management personnel, if I want to do some fraud, I can anyway do the fraud, right? It is my intention that I would want to do the fraud. So I do not care if there is any control or there is no control. So, because items may have been misappropriated by employees, therefore, there is a risk that inventory records can be inaccurate. So as an auditor, how are you going to rely on that inventory list or in the inventory record? Because you don't know if that inventory record itself is correct, right? It can be misstated. The control risk is, see, you already have tags in each of the item displayed. There is tag in each of the items displayed. That is not the only control. Inventory is also physically verified on monthly basis. They are also verifying the physical like inventory to find out if there is any discrepancy. The client is already doing that. So they are the controls which are devised by the client itself. Despite all the controls, employees can still collude and inventory records can be misstated because of this. Now, what will be the detection risk over there? Detection risk can be because of wrong audit procedure or because of the sampling, right? So what is the detection there? Risk that auditor evaluates, controls, or auditor does substantive testing on samples, but not on 100% of the population, due to which auditor may not be able to detect items which are stolen. See, even as per 5 SA 501, you remember SA 501, you go for the physical inventory count, right? Now, in physical inventory count, when the client is doing the count, you are only doing the test checking. You don't check 100% of the samples along with the client, right? So in that case, you are only doing the sample testing. Now, there can be chance in the remaining of the items have been stolen. How would you know? So that will be your detection risk. Yes. Now, this question was from a case scenario where you had to identify inherent risk, control risk, detection risk. So you also got the examples from it. Now, I want to do one question where come to question number 5, guys. So question number 5 says the standards on auditing do not ordinarily refer inherent risk and control risk separately. So what do they refer them as? What do they refer them as? Inherent risk and control risk in a combined manner? Risk of material misstatement. But rather do a combined assessment of risk of material misstatement. Explain. Because both these risks, why do we refer that as one? Because both are entities risk. These are not our risk, right? Like this is not the risk which is raised because of the auditor. These are entities risk. So how will you write this answer? This is a RTP question which says that ROMM at assertion level comprises of two components, that is inherent risk and control risk. Both these risks are entities risk and they exist independently of audit. I'll repeat. Risk of material misstatement at assertion level comprise of two components, one inherent risk, second control risk. And both of these risks are entities risk and they exist independent of the audit. Now we have to explain what is inherent risk and what is control risk. Inherent risk is susceptibility of an assertion. Assertion about what? Where do you see the assertion? Assertions in class of transaction or account balance or disclosure. So can you tell me, acha, I'm just diverting a topic a little bit, but can you tell me genuinely do you understand the meaning of assertion? No? Okay, I tell
Yes,
you.
a little bit.
Okay, can you try to describe? I'm not judging, but like I just wanted to know, like, what it can be.
It's a maybe a representation made by the management, so that the auditor can take that as a prerequisite to determine if there is any potential misstatement in the while conducting the audit.
Correct. So basically, in simple word, the assertions are the claims made by the management. Like for example, if I tell you that this iPhone is mine, right? So what I'm trying to make, I'm trying to make a claim that I own this phone. Any risk and reward related to this phone is mine. If I tell you that this phone is of 50,000 rupees, I'm trying to give you the valuation of it. So I told you the right, I told you the valuation. If I'm showing you this phone at this moment, I'm trying to show you that this phone exists as on today, on 12th of April. So this existence, rights, and the valuations are nothing but the assertions that the client is making, your client is making. Are we clear? So assertions are the claims made by your client that they own certain things or they own like they have an obligation. That, for example, if I tell you that I have to pay 10,000 rupees to my husband, I am telling you that I have an obligation existing today to pay 10,000 rupees to my husband. That is a claim I am making. Now you come as an auditor and you verify whether it is correct or not. Yes?
Yes.
Is it easy now? So
Yes.
a client can make assertions for a class of transaction, for example, sales purchase, or for account balance, for example, debtors creditor, or for any disclosures in the notes to account. Where do you see the disclosures? In the notes to account, right? But what is the inherent risk? That the assertion about a class of transactions, susceptibility of an assertion to a misstatement, which could be, that could be material. It has to be material, huh, by the way, guys. Matlab, like you are not going to just consider everything as inherent risk if it is a 1 rupee problem. No, no, no. It has to be a material, like, misstatement. And then assuming that there are no internal controls. Yes. Then comes the control risk. It is a risk that misstatement could occur in.
Can we write the answers in a flowchart manner, or should we write
No,
it
no,
only
no.
in
You are
paragraph?
just doing it now.
So
You
in
won't.
exam, we should write it only in paragraph or
Yes,
points.
points. We are doing this now so that it becomes easy to study sometimes. That is why I utilize the space like that. That could, okay. So control risk is the risk that material misstatement that could occur in an assertion. Assertion related to what? Assertions about COT, class of transaction, or, and you can't even write these abbreviations. I'm just writing these abbreviations now. About a class of transaction, account balance, or disclosure. Risk of material misstatement that would occur in this will not be prevented or detected and corrected on timely basis by entities internal control. That entity internal control will not be able to prevent it, even though the control is there. Now, under this risk topic itself, you have a question which is about, we are not writing this, we already have this answer, but we are just reading it. There is a specific topic in your chapter 3 which talks about there are certain risks that require special considerations of the audit. Like when you are considering the inherent risk, control risk, and detection risk, in those risks, there are certain elements, certain circumstances, certain indications that you will see at the client place where you have to put special considerations. Right? So significant risk often relate to the significant risk often related to the significant non-routine transaction. If I'm making sales and purchases, normally I'm not going to misstate those numbers, but suddenly I have a very special order related to client, and you see in normal the client is making a sales of 10 to 15 lakh rupees every month. How come suddenly there is a sales in the month of March of 50 lakh rupees? Like this is unusual. So whenever there is a judgmental matter or non-routine transaction, the non-routine transaction can be unusual or due to its size or the nature, and therefore occur infrequently. The judgmental matters may include development of accounting estimate for which there is a significant measurement uncertainty. Just say, for example, can you give me an example of accounting estimate where the client needs to measure the amount and there is a complexity in measuring? Just go back to your accounting knowledge and can you give me example of any accounting estimate where there is a complexity? See, provision for doubtful debt is also an accounting estimate. Provision for obsolete inventories are also an accounting estimate. But it is not very difficult.
Method of choosing the method of depreciation.
Choosing the method of depreciation, yes, sometimes for certain clients, certain nature of business, it can be a complex matter. Calculation of
And
gratuity
estimating the
provision.
useful life of the
Estimating the useful life of the
useful life.
asset, yes, it can be. Priya, sometimes it can be gratuity. Like for example, gratuity is payable only after the employees has spent certain years, right? Like certain 4.8 years or so with the client, and then only the gratuity becomes payable to that. But company makes provision every single month. right? So there is a complexion, and that is why for provision of gratuity is not calculated by the client, it is actually done by the actuaries, the people who qualify the exam of actuary. They calculate the provision for gratuity pension plan, because it is on future oriented, right? So whenever all these matters are involved, no, there is always a risk that something or the other client may do over here. So, in the context of significant risk, explain the factors to be considered by the auditor in exercising judgment as to which risk are significant risk. Now, let's see the answer. In exercising judgment as to which risk are significant risk, auditor shall consider. So this is the question. It is not telling you that it is a significant risk itself. You have to apply that judgment, and when you are applying that judgment, you have to find, like, just see these keywords: factors to be considered by the auditor in exercising judgment as to which risk are significant risk. First, when there is a risk of fraud. Whenever there is a risk of fraud, it is going to be a significant risk. Wherever there is a significant economic, accounting, or other developments in the regulatory requirement, therefore requires special attention. Can you tell me the name of an act which has recently been, like, significantly developed and which is part of your syllabus? The change is not, but the act is part of your syllabus.
I'm not sure, ma'am. WASF something.
Sorry, Priya?
Ma'am, I'm not sure. I think WAFF something I heard.
But have you not heard that Income Tax Act has just recently been changed?
Was about to
Yes.
say that, ma'am.
Exactly. So yeah, so it is. So you passed your exams before that, huh? Before all these changes are implemented in your syllabus.
Yeah.
Then, if there is a complexity of transaction, again there can be a significant risk involved. Oh, if the client is doing the transaction with the related parties, can you tell me the standard name? Where do you see the related party transactions and disclosures?
550.
SA 550. Or whenever there is a subjectivity involved in the measurement of the financial information related to those risks, especially those measurements involving wide range of measurement uncertainty. Or whether the risk involves significant transaction that are outside the normal course of business, like any
Ma'am, you're
transaction
not
which is.
audible.
I am not audible. It's just a second. I'll check. Oh my God, what happened? Let me just quickly check. Why my internet is so unstable. Sorry, guys. Just